Welcome back to the Balancing Act podcast. Today's episode is Tax Insights for 2025 filing season. I'm Mike Mondelli, and joining me is Ryan Nance. We work together in Singer Lewak's Tax Advisory Group, and today we're diving into some topics for the 2026 tax filing season. Top 5 most searched One Big Beautiful Bill tax topics. This is the first filing season where these rules affect your federal income tax return, meaning your 2025 return filed in 2026. We'll explain what the headlines mean in real tax terms like deductions, caps, phase-outs, forms, and record keeping. And we'll do a little bit into the technical side because these topics affect not just individual taxpayers, but also employers, gig platforms, lenders, and tax preparers. So we're going to talk about how some income gets reported, what counts as qualified, how to compute some modified adjusted gross income phase-outs, and how a new Schedule 1A flows into your Form 1040. As a quick note, this is just general information, and for your specific situation, be sure to talk to a tax professional.
Yeah, so the no tax on tips is a big topic that has been trending for several months with the passage of the One Big Beautiful Bill Act. So I was talking to my barber. He loves to talk taxes with me, and he was asking about the no tax on tips, because when I go see him, I always leave a tip. And if you don't leave a tip for your barber, he's one of those.
Please do that. Please do
that. It's good manners. And so we were talking about the no tax on tips. And as we were talking about it, I began to realize that he's very, very business savvy, very, very good businessman. But he had really I guess, misunderstanding about how it's supposed to work. And so I thought it might be a good idea, because it is a popular topic, it might be a good idea to just talk about the mechanics. Okay. So I'm going to throw it to you. And so when we talk no tax on tips, what are the how does it work? What are the real mechanics behind it? Because a lot of people are wondering about that.
Yeah, and this is one of the most searched on Google, one of the 5 most searched questions about the One Big Beautiful Bill for 2025 tax return filings. So the no tax on tips, it's a new temporary federal income tax deduction. It's temporary because it's only for tax years 2025 through 2028 for qualified tips that are received in eligible tipped occupations. So if you qualify, you can deduct qualified tips up to the annual cap of $25,000 from taxable income. It's not an exclusion from your wages for reporting purposes. The tips are still income, so you still have to report them, and it's still under the payroll tax rules. It's not fully exempt from all taxes.
Okay, all right. So stop, because there are key words that we have to pay attention to in the tax world. So you said qualified tips. What is a qualified tip?
Well, the IRS describes qualified tips as voluntary cash or charge tips received from customers or through tip sharing. So a very simple example would be you are a server or a bartender at a restaurant and you receive a voluntary cash or credit card charge tip from a customer, or your establishment pools all the tips together, and then at the end of the shift, they divvy them out equally to all of the server staff and wait staff and bartenders, that through tip sharing. And the word voluntary is important. It matters here. So a mandatory service charge that's added to the bill doesn't count as tipped income for the no tax on tips.
Okay.
So another key requirement would be the tips have to be connected or received in an occupation that, this is a quote here, customarily and regularly received tips on or before December 31st, 2024. And you have a list there, right, of what some of the eligible occupations are for this deduction?
Right. And there's a lot of them. We talked about this on one of our previous tax tips videos, but to reiterate, the IRS came out with a list of occupations that are customarily and regularly tipped occupations. Okay. And so they broke it up into 8 buckets, right? And so I'm going to give you the buckets. There's beverage and food service, which would be our normal set, wait staff, bartenders, etc. Entertainment and events, which the IRS said would include musicians, DJs, ushers, coat room attendants. Then there's the third bucket is hospitality and guest services, which would be our hotel desk clerks, housekeepers, bellhops. Then home services, example, electricians, plumbers, HVAC techs, personal services such as personal care aides, event planners, photographers, nannies, tutors, caretakers. Then there's personal appearance and wellness, such as barbers, what we were talking about. So my barber would be
Right.
in there, hairdressers, manicurists, fitness instructors, and even tattoo artists. Recreation and instruction, such as golf caddies or sports instructors or tour guides. And finally, transportation and delivery. And the IRS says that might include delivery drivers, movers, parking, or valet attendants. So the list is long. There's a lot of occupations that are covered that can fall into that customarily and regularly tipped occupation.
Yeah, what they're going for there is they're trying to provide a list of the occupations that got tips before this law was in place. So that way, everyone out there in any industry can't just recharacterize their income as tips and try to say that it's non-taxable under this rule.
Gotcha. Okay, so the other thing you mentioned is caps and phase outs. Plain English, what are we talking about?
Yeah. For tips, the phase out is based on your modified adjusted gross income. And the IRS threshold for this is $150,000 for a single filer or a head of household and $300,000 for married filing joint returns. So once you get above those thresholds, the deduction starts to get reduced as your income keeps rising. So for planning, you might be able to do a little bit of work managing your modified adjusted gross income, maybe some retirement account contributions, or if you have the ability to time when you receive some of your income, that may be able to change some of your eligibility here. Of course, 2025, the year has ended, so you don't have the ability to go back and do much planning at this point for last year,
Right.
but based on how things are shaking out for your 2025 tax return, you may be able to change a few things in 2026.
Okay, so let's say I'm a server at a restaurant and I made 18,000, let's just say I make $18,000 in tips over the course of 2025.
Yep.
So does this mean that I don't pay any tax on those tips? They're just completely tax free, or how's that work?
You'll definitely still pay payroll taxes on that. So FICA, Social Security, Medicare, you'll definitely still have those on there. And the income is still reported on your line that on your tax return that says wages, tips, and other types of income. At the end of it, though, you will get a deduction for that $18,000, assuming that there's nothing else that limits it here, like the phase out range, and
Right.
that you have it's all qualified tipped income. And like you said, you're in a qualified profession, the $18,000 will be a deduction or a reduction in your taxable income.
Okay. So this is all brand new. Nobody's actually done any of this on paper.
Not
But
yet.
what not yet. We're getting ready to. Busy season is here, so everyone's excited. I know. So what do you think might be some mistakes or mistakes that you could anticipate being made, or items or issues that might pop up?
One thing that's going to be a surprise to a lot of people that are in tipped jobs is that there's no requirement for 2025 that your employer actually breaks out or reports the amount of qualified tipped income on your W-2 or 1099 that you're going to receive from them. This
Okay.
bill was passed in mid 2025, and by the time the IRS came out with the guidance, it was really too late for them to force the employers to go back and figure out how to update their systems to report this information. So your employer may provide you with a statement of your qualified tips, or they may not. You may have to go back through your payroll pay stubs. Maybe your year-end pay stub may have the total of tipped income on there, and you could use that. So
Right.
being able to document the amount of qualified tipped income that you say qualifies for the deduction, that may be a little bit of a hurdle for some of the individuals. And then
Right.
you have to break out and exclude any mandatory service charges. That's where I think without the employer provided statement of what tips are qualified, it will be very difficult for you as an individual tip earner to know which tips were voluntary and which tips were mandatory service charges.
Gotcha. Yeah, that makes sense. And the other thing to keep in mind for our listeners is that, it's not only on the individual side, but I think as a business owner that might operate a business that has employees that are customarily tipped, you're probably going to get some questions, maybe potentially some questions from your employees. Like you just mentioned, their documentation, their records might need to, have a bit more than in years, previous years for them to be able to take this deduction.
One other big thing that might trip some people up is the $25,000 cap on the amount of qualified tips that can be deducted is per tax return, not per taxpayer or per individual. So if you and your spouse both work in a tipped job,
yes,
you may miss out on some of this if you both earn $25,000 or more, or really even if you both earn $12,500 in tips, that will hit the $25,000 cap, assuming you're not phased out. If you each earn more than that, or one of you earns significantly more tipped income and your total qualified tips exceed 25,000, you can only deduct up to the $25,000 amount. So that may be sort of a marriage penalty, which is what people in the tax industry refer to some of these things like. You sort of get burned by being married, filing joint, and having a lot of tipped income here,
right,
at least until Congress maybe comes out with a technical correction for that and says, well, we didn't mean it that way. We meant 25,000 per person, but that's not the way it works for this year. It's 25,000 per return.
Interesting. Okay. And another thing to keep in mind, if, for any of the accountants listening, we are not included in the customarily tipped category.
That's right.
So anyway,
but if you want to tip your accountant after they prepare your tax return,
feel free
no
to
deduction.
do so. Yeah. No deduction on the
no deduction for the
side.
accountant on that. That's right.
That's all right. I'll take a tip. All right. So that was one of the items that is heavily Googled since July 4th, 2025, and the passage of the One Big Beautiful Bill Act. The other one that we've had some questions about and that is heavily researched is the no tax on overtime. And from what I can gather, we use the term shocked to learn that it's not the entirety of overtime pay that's deductible. So okay. So what is it? What do they get?
Yeah, the overtime deduction under the no tax on overtime is only for, quote, qualified overtime compensation, which the IRS describes it as the pay that exceeds your regular rate of pay. So what that means in plain English is if you earn time and a half for working overtime, only the and a half qualifies for the no tax on overtime. So it's basically the overtime premium, not the whole overtime paycheck. Let's say your regular rate of pay is $20 an hour, get paid overtime at time and a half. So your overtime rate would be $30 an hour for the same. In this case, the regular portion of pay would be $20 and the overtime premium would be $10 an hour. So the and a half there is $10. So you would multiply that $10 by the number of overtime hours worked in the year, and that would allow you to estimate or come close to what the deductible overtime premium is. Of course, as we'll get into it, that's subject to caps and income limits.
Okay, so like the no tax on tips, of course, there are caps and phase outs. So what are the caps and phase outs with this one?
The cap is $12,500 of overtime can be deducted for a single filer and $25,000 for married filing joint filers. And the phase out range, it's the same as the no tax on tips, starts at modified adjusted gross income at $150,000 for a single or head of household and $300,000 for a joint.
I mean, I think that the modified AGI limits are pretty reasonable. I mean, 150,000 for single, 300K for.
And you have to be above. You have to be above that before your deduction starts getting reduced. So up to those amounts, you're getting the full deduction.
Not a bad deal. Okay, so Question: if you say you get daily overtime under state law, would that does that count? I know we're kind of flipping between federal and state here, and I don't want to confuse things,
Mhm.
but that has been a question that has popped up.
The rule is really written for a 40-hour work week under federal law, Fair Labor Standards Act.
Okay.
So if you're getting daily overtime, you'd still have to probably look at it on a 40-hour per week basis. Talk through this with your tax return preparer, your CPA, and make sure that they are aware you worked overtime or that you had tipped income in 2025. And if you have any pay stubs with information week to week, month to month that show a breakdown of that information beyond what's on your W-2, bring
Right.
those to your appointment, send them to your tax preparer, make sure they're aware that you should qualify for these deductions. And you're going to have to discuss it with them because in 2025, this information is not going to be detailed on your W-2
Mm-hmm.
and you'll need some additional records. Then once the return's filed, I'd suggest, of course, it's great advice anytime you want to retain your tax records for usually, 7 years is a number that's thrown out a lot, going to be entirely clear to the IRS how you
Yeah.
came up with your numbers. You'll want to
Right.
retain your records so that way, if you get an IRS audit of your tax return, you'll have the information easily available and how you calculated your overtime, how you calculated your tips.
Yeah, absolutely. Because as we have learned in the past, anytime there's one of these new bills that comes out and the IRS is dealing with a new issue or taxpayers are dealing with a new issue, save your records, have some good documentation for whatever deduction or credit you're taking. So good advice,
Yeah,
without a doubt.
I think the no tax on overtime will be, like you said, people are going to be shocked a little bit by it when they start to do
Yeah.
the math on their tax return. And I did a little example that I posted on LinkedIn a few weeks ago, going through the math, figuring out how much tax is actually saved. And in the example I wrote, after having worked 10 hours a week or like 10 hours a pay period of overtime, 240 hours of overtime, and the example individual earned just under $13,000 in
Mhm.
overtime pay. Of that, only the time and a half was eligible for the deduction, and so this resulted in tax savings of about $950.
Okay.
It didn't seem like that was obviously, you save almost $1,000 in tax. That's great.
It's
I'd
great.
rather
It's
not
great.
pay $1,000 in tax. Of course, that's
Sure.
great. But it seemed like a low amount
It's
compared to the amount of time you spent working that
yeah.
overtime under the idea that this is going to be non-taxable.
Yeah. Yeah. You think you're getting something that's really great, and then you actually do the math, and fingers crossed it works out. But a lot of times, it sounds in theory a lot better than what it ends up being on paper. So, but
Yeah,
yeah,
if you
do
if
do
you
the
do
work.
something if you do something because you've heard it has a great tax advantage. Oh, there's no tax on overtime. I'm going to work a lot of overtime this year. Then you find out maybe it wasn't such a good deal because you spent a lot of time away from your family or away
Yeah.
from your other interests
Yeah.
to save a tiny little bit of
Save a
tax
thousand
rather
bucks.
than a lot. Or sometimes maybe you do something else because you heard it's got a great tax advantage. Like you heard that there's no tax on car loan interest now under the one big beautiful bill. And so you've heard
Yes.
there's this new car loan interest deduction. So you ran out and you bought a car in 2025. Maybe it qualified for this new deduction. Maybe it didn't. So let's switch gears. Let's talk about this and let's talk about the car loan interest deduction. What did the IRS and Treasury Department say about this?
Okay. This is, I guess, the third most searched topic. But basically, there's a new deduction that's available for interest paid on qualifying vehicle loans incurred after December 31st, 2024. So January 1, 2025, it's out there. It's to purchase a new vehicle for personal use that meets, and I'm going to use the exact terms, final assembly in the United States requirement. Okay, it's capped at $10,000 per year, and is available whether you itemize or you just take the standard deduction, which is great. It applies to everybody essentially if you bought a new car, final assembly in the United States. So
Yeah.
yeah.
Okay. It sounds good. But it's a loan interest deduction, not a tax
Yes.
credit. Can you
Right.
explain why that distinction matters?
So it's a deduct. It's not a dollar for dollar like tax credit. Okay. So there's some misunderstandings about car loan interest deduction. So two things. It's interest on a loan, which is not going to apply to a lease payment. Okay.
Oh,
So
okay.
that's one.
Loans only, not leases.
Loans, not leases. And number two, it's up to $10,000 in deduction, not a dollar for dollar credit. People get that. That's a confusing thing. You hear $10,000 deduction, that's one thing, but a credit is another thing. So that determination is pretty important. So essentially, with the deduction, your tax savings are going to depend on your tax bracket. If that makes
Yep.
some
And we
sense.
talked about tax brackets in one of our tax tips videos. So
We
check that
did.
out.
We did. Yeah. We talked about the marginal tax rates and how that works. So this is one of those items that is going to depend on your marginal bracket, tax rate bracket.
So if you heard that there's a $10,000 deduction if you buy a new vehicle, and then you go and file your tax return, and your tax return preparer says, yeah, you got a no tax on car loan deduction of $500. You say, what happened? What happened to my 10,000? I'm guessing that you spent $50,000 on a vehicle and you thought you'd get a $10,000 deduction for it, but you actually only get a deduction on the amount of interest that you paid on your loan payments, right?
Yeah,
And
it's
if that
it's
interest adds up to 10,000 or more in the year, that's how you'll get to
you,
the
you,
10,000 cap, and that's a lot of interest.
that's a lot of interest. I would love to see whatever vehicle that is. I don't have one of those, whatever that is. But yeah, it's the interest. It's not what you actually your loan amount is for. It's strictly tied to the interest payments. And again, final assembly in the U.S. Going to be some addition. There's obviously more information that is out there as far as what final assembly means, but just big picture, final assembly has to occur in the U.S. and it's for the interest, not the actual loan amount.
This is the first year that this deduction is available, of course, because it's under the one big beautiful bill. What kind of documentation do you think you should be bringing to your tax return preparer for this if you bought a new vehicle that had final assembly in the US and you bought it in 2025? What kind of records should you keep? What kind of documentation is your preparer going to want to see?
I would say number one, loan paperwork, just standard loan paperwork that'll have interest amounts, whatever, interest percentage, whatever. Year-end interest statement from the lender. And I would say any type of documentation that whoever you purchase the vehicle from can provide, or the manufacturer can provide, that the vehicle qualifies, that final assembly occurred in the United States. That's a big deal here. The other thing is you're going to have your VIN number, and that is for actual reporting on the Form 1A that we're going to talk about later. But I would say that loan paperwork, year-end interest statement, VIN number, documentation that the vehicle actually qualifies under this provision of the One Big Beautiful Bill Act.
I had heard that there was still a public comment period open for this. So we're recording this in February 2026. That'll probably close soon. Does that matter? Are these rules finalized, or is it possible that maybe they might change?
It's possible there might be some change, but the fact that we're already we're in the busy season, we're in tax filing season. We're past, I think the filing season started on the 26th, maybe 29th. Regardless, yeah, it's still open for comment, and I think that might have been the 2nd of February that comments were going to close, but as it stands now, these are the rules. We're going to play by the rules that we have. If it changes, great. But we want to be compliant with the guidance that we have at this point. So if there are any updates, of course, we will get that information out to everybody. But as it stands now, the general rules are what they are.
All right, let's move on to the fourth most searched tax topic under the One Big Beautiful Bill on Google, and that's the enhanced deduction for seniors or senior bonus deduction. Can you tell us what is it and who qualifies?
Okay, so it's kind of like the no tax on car loan interest. There's some confusion. A lot of folks are thinking it's a credit, but it's a deduction, right? So it can reduce your taxable income, not dollar for dollar like a credit, but it's for taxpayers who are 65 or older at the end of the tax year. Okay,
Okay.
we're going to talk about Schedule 1A here in a little bit, but it's calculated on Schedule 1A, and it's not permanent; it's temporary. Let's see, dollar amounts. The maximum is $6,000 per eligible taxpayer, and up to $12,000 if we're, for example, doing married filing jointly and both of the taxpayers qualified. So it's up to $12,000. But again, we've got income phase outs that are based on our modified adjusted gross income, like everything else we've discussed today. So
Yeah,
65 or
that's
older, it's great. It can be great for you.
if you have two spouses, both 65 or older, then you might qualify for the full 12,000 deduction.
As it stands now, yeah, that's the rule. So again, we're not going to go too deep into all the different phase outs, but if you are 65 or older by the end of the tax year, then talk to your tax preparer. This is a new thing that's out there, courtesy of the One Big Beautiful Bill Act. And again, it can reduce your taxable income, but don't get that confused with a credit, meaning a dollar for dollar reduction.
Yeah, how does the phase out work here with modified AGI?
So with the modified AGI, there are limits, and as you exceed the limits, for example, say you're single and you qualify for this, and the phase out is $75,000. When you get above that $75,000 threshold, dollar for dollar, potential benefit gets reduced.
Okay, so just like the AGI, modified AGI thresholds or limits for the no tax on tips, no tax on overtime. Once you hit that, your deduction starts to get reduced.
It starts to get reduced. Yeah, same exact principle.
What do you think, if you're helping a family member here, or you're a caregiver working with seniors, what do you think they should be gathering here documentation wise? I'm not sure even, how does the IRS know if you're over age 65? Well, maybe they cross-reference with Social Security information, but what kind of things should people be gathering information wise for this deduction?
I mean, for this one, and again, it's new, so we don't know what the IRS is going to be looking at. But I mean, for the most part, if you're 65 or older, you've been filing tax returns for years. The IRS should be able to verify your date of birth. If you've earned any income, this one should be. I would think it would be relatively easy. Either if you're, it's going to be just kind of the normal walkthrough on your 1040 as an individual, right? If your modified AGI is above X number of dollars, then you're going to get phased out. Again, this is all going to be calculated on Schedule 1A, which is a new form for the 2025 filing year. But for this one, I don't think there's going to be any type of crazy information that you're going to have to get. I mean, the IRS is going to know your date of birth. If you get a W-2, that's great. Any type of Social Security documents are out there. I mean, we can verify your date of birth, your age. So I don't know that there's any special information, like with the car loan thing, you might have to push back on the dealership or the manufacturer to get some information. This was finally assembled in the US. With this one, I think it should be relatively straightforward as far as, proving that you're 65 or older by the end of the tax year. Your modified AGI is what it is. So I don't think it's going to be a heavy lift for most individual taxpayers.
I think you're right. This one is pretty much computational, or it's just a calculation that's going to be done if you qualify. And the only real variable seems to be what is your modified adjusted gross income. So you may have a tax planning opportunity there
Right.
to, if you're getting close to the phase out range, maybe you can find some deductions. Maybe you can plan ahead for 2026 and see if you can keep your modified adjusted gross income below the phase out range.
Pretty
Otherwise, I
much.
think you're right. This does seem pretty straightforward.
It is. Yeah. And so with that being said, we've talked a lot about Schedule 1A, which is 1-A, and this is for Form 1040, which is our individual income tax return. So all of these deductions that we've talked about are now going to be reported on this Schedule 1A. It's been there's a lot of questions about it. Can you just kind of boil it down? What is this new schedule?
Yeah, this is the 5th in our top 5 most Googled tax questions for your 2025 tax return under the One Big Beautiful Bill. So Schedule 1A is a new IRS schedule titled Additional Deductions. It basically consolidates the 4 things we've talked about here today: the no tax on tips, no tax on overtime, no tax on car loan interest, and the enhanced senior deduction. You're going to complete this schedule and attach it to your Form 1040, or if you file a variation of that, 1040 SR, 1040 NR.
Okay, so with this schedule, do you have to itemize to use Schedule 1-A?
No, you do not need to do itemized deductions to use Schedule 1A. The intent here is that if you take the standard deduction, you can still claim these additional deductions. And so Schedule 1A is separate from itemized deductions on Schedule A. They probably should have named this form something slightly different to not cause that confusion. There's a lot of numbers and letters available. They went with 1A, which, just on the face kind of makes you think, well, this is related to Schedule A then. But no, it's not. You can take the standard deduction and still claim additional deductions on Schedule 1A if you qualify.
I've looked at the form. It seems to be pretty straightforward, very general. We don't have it up on screen, so can you just kind of walk us through the key structure of it? What's it kind of look like, if you could describe that?
Part 1 of Schedule 1A is going to calculate your modified adjusted gross income, or modified AGI, for these deductions. So it takes your AGI from your main return, your Form 1040, and it adds back certain excluded income items. And then that modified AGI is used to calculate all of the 4 separate deduction phase out ranges.
Right.
I think the form is straightforward at first glance. It calculates your modified AGI. Then you fill out no tax on tips info and no tax on overtime info, no tax on car loan interest, and enhanced deduction for seniors. And then you add it all up at the end and it tells you what line to put it on. I actually, when you take a deeper look at the form, it's written somewhat, it seems like, by someone who's never tried to file a tax return before. Under the no tax on tips section, it says, if under item 4C, if you only received qualified tips as an employee with respect to employment with one employer, enter the larger of line 4A or line 4B. If you receive tips as an employee in more than one occupation, see the instructions. Look, you and I are tax professionals. We look at tax forms all the time. We understand what this means. It's talking about if you get tips from more than one employer. But to write it this way, if you receive tips as an employee with respect to employment with one employer, it sounds like, maybe they used an AI tool to draft the language. I don't know. I wouldn't have written it that way. It's a little confusing if you're not used to reading tax forms.
But tax forms have to be confusing, right? That's just part of it. There's always confusion with tax forms. But I'm looking at the form right now, and it's terribly complicated. But again, this is kind of first year out of the gate with this. So looking at the form, what do you think might be some, probable potential mistakes, potential areas that might give taxpayers trouble,
Yeah,
if any?
If it is the first time, I think there's definitely going to be some hiccups or glitches, especially if you're doing this yourself. I always recommend hiring a qualified tax return preparer, but some of the missteps here could be, if you choose the wrong filing status, you might have a problem because some deductions do require you to file married filing joint if you are married rather than married filing separate. If you
Right.
mistype or misenter a social security number, that will cause a problem. And if you're figuring the no tax on overtime, if you entered your gross overtime pay rather than
Mhm.
just the premium portion of the overtime or that and a half portion, then
Right.
it's not going to calculate correctly. Another one would be forgetting that the loan interest is capped and that the vehicle is required to meet certain eligibility requirements. I think that
Right.
it's very likely that anybody out there that's doing their tax return on their own, it's the only tax stuff they ever look at is once a year when they file their income tax return.
Well, yeah.
They're going to
Yeah.
say, "Oh yeah, I bought a car in 2025," and they're going to plug
Mhm.
this information in, and maybe their vehicle doesn't meet the eligibility requirements. They may get a letter from the IRS after they file
Yeah.
their return saying you're not eligible for this deduction. Maybe they owe some more tax.
Yeah. I mean, I think that for the most part, especially if you're using, and again, you have to put in the correct information
Right.
regardless. But I think that if you're using some sort of e-filing software or you're working with a tax professional that has access to, some sort of robust program, for the most part, your modified AGI is going to be calculated, which is a huge determinant in all of these different deductions. But yeah, I mean, just kind of the basic stuff, make sure that your social security number is correct, and obviously, as we've discussed, you want to make sure that you're putting the right numbers in where they need to go. So again, don't take the amount of your actual car loan. You're going to use the amount of the interest.
Right.
So
Yeah, I think that's another one that's going to be a high error rate on the
yeah.
IRS side. They're going to see lots of very high loan interest amounts, and then they're going to send a letter out to all these taxpayers who are going to find out they actually put in the purchase price of their vehicle, not the
Right.
interest amount they paid.
Right. Yeah. Okay. Well, I think that it should make for hopefully not I'm hoping that it's not going to be too painful of a busy season for all the tax professionals and individuals, businesses, trying to take advantage of some of these new deductions. So we'll see.
We'll see. If today's episode on the top 5 most searched One Big Beautiful Bill Act tax changes for your 2025 tax return was helpful, please share the show with someone else who earns tips, works overtime, bought a new vehicle, or helps a senior file their return. And if you have any questions about today's topics or need help with other tax issues, please contact us or your Senior LEWAC professional. Thanks for listening to The Balancing Act.